An earnings multiplier, also known as a price-to-earnings (PE) ratio, is a financial metric used to evaluate the valuation of a company's stock relative to its earnings. It is calculated by dividing the market price per share of a company's stock by its earnings per share (EPS). The earnings multiplier indicates how much investors are willing to pay per dollar of earnings generated by the company. Here's how it works. 1. Calculation. The earnings multiplier is calculated by dividing the market price per share of a company's stock by its earnings per share. The formula is expressed as follows. Earnings multiplier equals market price per share, earnings per share EPS. 2. Interpretation. A high earnings multiplier indicates that investors are willing to pay a higher price for each dollar of earnings, suggesting that the stock may be overvalued. Conversely, a low earnings multiplier suggests that the stock may be undervalued, as investors are paying less for each dollar of earnings. 3. Comparison. The earnings multiplier is often compared to those of other companies in the same industry or sector to assess relative valuation. Companies with similar growth prospects and risk profiles may have similar earnings multipliers. 4. Considerations. While the earnings multiplier is a widely used valuation metric, it has limitations. It does not consider factors such as future growth potential, risk, or overall market conditions. Additionally, earnings can be subject to manipulation or volatility, which can impact the accuracy of the multiplier. Example, let's say company XYZ has a market price per share of $50 and earnings per share, EPS, of $5. To calculate the earnings multiplier equals $50 per $5 equals 10. This means that investors are willing to pay $10 for every dollar of earnings generated by company XYZ. If similar companies in the industry have earnings multipliers ranging from 8 to 12, company XYZ's stock may be considered fairly valued relative to its earnings. However, further analysis is necessary to consider other factors, such as growth prospects, industry trends, and risk.